In this presentation, you will investigate CFP Board's Domain 4, Developing Plan Recommendations. By the end of this lesson, you should be able to discuss the process of considering alternatives to the client's current course of action and describe issues relevant to developing plan recommendations. CFP Financial Planning Practice Standard 400-1 says, a financial planning practitioner shall consider sufficient and relevant alternatives to the client's current course of action in an effort to reasonably meet the client's goals, needs, and priorities. In financial planning as well as life, there's seldom only one solution or a way of solving a problem or getting somewhere. The planning process, as described in the CFP Board's practice standard, gives us a systematic, logical approach to looking at where the client is now versus where they want to go. And you'll start by realizing the shortcomings, the vulnerabilities, the challenges, and even the gaps in the current plan. You'll identify alternative solutions, which can be processes or strategies or financial planning products. And once those alternatives are identified and assessed, you select the best course of action within the context of the entire plan, the holistic plan. And that's the integrative nature of financial planning. During your preliminary courses, you studied various strategies and resources. Let's consider for a moment that your client, maybe in their 20s or 30s, have a goal of starting to save towards retirement. There's different alternative processes that you could systematically employ in reaching that goal. You studied level payments, the same amount periodically, maybe end of year. Serial payments, payments again that occur periodically, but the amount of the contribution increases at some inflation rate. You looked at age banding methodology, in which you took a look at the retirement period, divided that into different bands, and then set up savings and contributions for each one of those bands. Or you could employ a combination of level and serial, level with age banding and age banding with serial. Now consider an alternative situation. In this case, your client, maybe in their 50s, late 40s, have not sufficiently saved towards retirement. And particularly the client who's entering that retirement period, there's going to be shortfalls. And you have to come up with some strategy for dealing with the shortfalls. Some of those discussions may involve reassessing of lifestyle goals. If there's enough time, and if the risk tolerance of the client can accommodate greater volatility, repositioning the investment assets for increased growth, expected growth. Possibly downsizing the home. Initiating a reverse mortgage so that there's systematic cash flows coming out of there. Starting a new career, starting a part-time job, extending work. In your Business 502 course, you looked at a variety of different tax planning strategies that you could employ. These might include delaying or deferring income in that tax period. Replacing taxable income items with tax-exempt or tax-deferred items. Accelerating deductions as a way of lowering the taxable income. Are there any tax credits available? Offsetting passive gains with losses. Using charitable contributions as a way to, again, lower the taxable income. Employing tax-sheltered investments, shifting of income, and transferring assets during lifetime. These and many others that you studied in that course could be used in helping your client reach their goal of reducing their tax liability. You also studied numerous strategies and products available to you in helping your client systematically fund higher education costs for their children. And you know what some of those products are. A 529 prepaid tuition plan, a 529 savings plan, the Coverdell Educational Savings Account, U.S. Savings Bonds, and custodial accounts, UGMA, UTMA, to name just a few. In assessing the relative merit of each of the planning alternatives, you need to consider a variety of items. First of all, the alignment with the client's goals, preferences, constraints. Looking at the cost benefit of each of your alternative actions, and again, within that holistic sense, integrative nature. And of course, your planning actions need to take place in our ethical, legal, and regulatory environment. And as with any initiative, any type of planning, we need to consider the risk, and we try to manage uncertainty. Now, the graphic on this slide summarizes the way that a corporation might approach understanding risk. And in your Business 591 course, you looked at statistical analysis of risk, scenario analysis, sensitivity analysis, and Monte Carlo. Two of the techniques which are commonly used in financial planning to quantify future uncertainties, to get a handle on is this something the client can handle, is scenario analysis and Monte Carlo. Now, scenario analysis is an attempt to quantify risk by looking at a small set of likely outcomes. And I think a useful example of where scenario analysis would work well is with educational savings. So let's just say your client tells you they want to fund the entire cost of education for their child at a state college. You can calculate the savings needed, and that's going to work. And how will you do that? Well, you know the cost of that college today. You have a good handle on what that educational inflation rate is. You can project out what those costs will be. You'll have some type of assumption about expected returns, and from that you can calculate your contributions based on serial level payments or however you want to do that. But what if a different scenario plays out? The child decides not to go to that state school. For example, what if the child is accepted at a high-end private university? What if the child is accepted at an out-of-state public university where the cost is quite higher than the in-state public? Or what if some of the assumptions don't play out correctly? So you can run some different scenarios. You can present those to the client. And that can lead to a very rich conversation so that the client understands what the uncertainties would be, what the need would be given different scenario outcomes. Monte Carlo was a risk management tool designed to quantify the unquantifiable. In other words, a situation in which the number of scenarios is quite large and the data inputs may vary, and they might vary significantly. For example, in retirement, a lot of different numbers go into that retirement estimate, including longevity, healthcare costs, the income needs during retirement, when somebody is going to retire, and a number of the issues that you studied in your Business 505 course. The image on this slide, as you can see, runs tens of thousands of iterations, and in some cases Monte Carlos can run hundreds of thousands of iterations, in which you tell the computer the range of the inputs, and just random selection, random matching produces this wide range of possible outcomes. As you see on this image, the client could potentially run out of money anywhere from 70 to, from what I can see there, well over 100. But you can see where the projected short flow would be in the later 80s, or running out of money. This tool can provide a wonderful starting point in your conversations with the client. A conversation about the risk of running out of money and what the client might be willing to live with. Once you have a good handle on the alternatives that you're looking at in these areas that you need to improve or refine the plan, the financial planning practitioner shall develop the recommendations based on the selected of alternatives and the current course of action in an effort to reasonably meet the client's goals, needs, and priorities. And that's CFP Practice Standards 400-2. So based on your given set of assumptions, the alternatives, your professional judgment, and the client's goals, resources, attitudes, values, you make that decision whether to stay with the current plan, refine or fine-tune that current plan, or totally rework the plan. In synthesizing recommendations, again, there's a lot of issues you need to think about. And of course, we just mentioned about making sure that the risk is acceptable. Ensuring that the recommendations align with your client's goals, preferences, and constraints. Because if they don't, as you've discussed in other classes, the client's not going to stay with the plan or they're not going to implement the plan. In synthesizing recommendations, you might be working with other professionals who have areas of expertise that perhaps you don't specialize in. And of course, in selecting that optimal set of recommendations, you need to focus on that holistic benefit, not just on one specific area of the plan. And that's because financial planning is integrative in nature. What you recommend for one course of action has implications on other pieces of the plan. For example, this is a slide which was produced in a prior capstone course by one of the teams. And as you can see here, the recommendation was to refinance the current first and home equity line into one new loan. The good news, it increased cash flows by almost $20,000. The bad news is now that the mortgage interest deduction is lower, that was going to have a negative impact on the tax, because there's not as much tax write-off, not as much as a below-the-line tax deduction. Therefore, there was an increase in taxes due, in this case, of close to $3,500. But the after-tax increase, again, of this decision had a net positive cash flow of $16,295 for the client. In working with recommendations, you need to also understand that in some situation, that idea about that integrative or interconnections in the plan can play out because the client may have competing objectives. And here was an example that I created to kind of give you a sense of what this means. So the goal was to reduce the estate taxes by transferring assets prior to death. So that idea that we can lower the gross estate, thereby lowering estate taxes. What are a couple of the objectives? Well, one, the client doesn't know how long they'll live in retirement. So that idea is you don't want to give away too much, because you want to ensure financial security for your client throughout the entire retirement period. Likewise, there may be a competing objective that the client would like to give some to their heirs, but they might be resistant to the idea of creating a trust fund baby where they don't have the ability to really live out their potential, because the money's coming in and there's the tendency then to maybe not to give back to society the way they would be. So now you have a couple competing goals in here. You want to hold down the taxes, but you want to make sure you have enough, so you don't want to give away too much, and you don't want to give away too much that would create somebody to not go out and work, not follow dreams, rather than just take the money. Remember that in your discussions, in presenting your recommendations, it's a collaboration. And Lisa Bowie, a nationally known financial planner, routinely stamps her plan that gets presented in the client meeting with a stamp that says draft across it, because she wants to communicate to the client that this is simply the draft. It is a discussion. I need your feedback. And with that feedback, you may and might often have to rework the recommendations, fine-tune those, and that really aligns the client's goals, preferences, constraints, and will certainly lead to implementation. Another challenge when you're developing recommendation is dealing with the cash flow constraints, because one of the questions of your client will be, can I afford that, right? And so in dealing with those cash flow limitations, you may have to prioritize your recommendations. We're going to address the first 3 priorities here. You may phase in implementations. We're going to take a look at the first 5 priorities here, and we're going to fully fund the first couple, and we're going to partially fund the last 3, and because that's moving us towards that goal. You may postpone some of the implementations, particularly for the goals or the recommendations that are not a priority, or major gap, a major weakness. You might be able to figure ways to increase available cash flows to pay for some of those recommendations that you know will help your client. And finally, you've learned a lot in the program, and you're in position to start thinking outside the box. What are some creative solutions that I can recommend to my client to reduce the cash flow need? As previously mentioned, in developing your planning recommendations, you may collaborate with other professionals, and they might include portfolio managers, risk management specialists, accountants or tax preparers, estate attorneys, retirement specialists, bankers and credit advisors, attorneys, real estate brokers, and human resource department representatives, to include others. During your financial planning career, there's a very high probability that you'll be working with financial planning software. There are some wonderful packages out there that provide excellent efficiency, creative, consistent presentations for the client. However, and one of the takeaways I hope that you have from this course is that planning software is just a tool to support your work. A tool that you can efficiently show to the client your ideas and understand that the output of that software simply reflects the input. Outcomes are only as good as the input. Always remember, you can have a software packaged 300 pages with all the bells and whistles that could be put on a shelf, because it just doesn't speak to the client. They need to hear you. You need to be able to explain it. Remember, this software is a tool for what you bring to the table. John Guyton, another nationally known financial planner and spokesman for our industry, joined our capstone a couple years ago, I think. And during his live chat presentation, he made the following statements. Your recommendations represent the best decisions for this moment in time, realizing that we deal with a reality of uncertainty. And I think that's a really important statement. And I think it's also liberating. It gives us that freedom many times to say, you know something, the moment we create the plan, in some ways, it's obsolete because our clients' life is going to change. Assumptions aren't going to play out. But at this point in time, given the environment, given our projections, given the information we've received from our clients, this plan will help the client move towards their goals. So when you create this, it is very valuable. But we realize it's a process. Life happens, future realities rarely match the forecast, and so it's dynamic. The plan that you've developed will certainly improve the client's ability to get to where they want to go. realizing that we're going to have to continue to fine-tune this, to monitor it, to react, adapt to new changes, and then to go on and on. In the remaining presentations for this week, I'm going to be focusing on specific strategies and products that you'll be used in building your plan.